Marcus has a $3,000 emergency fund. He built it over 8 months, and he's genuinely proud of it. But in the last 14 months, he's dipped into it 4 times. New tires in March, car registration in June, a dentist bill in September, a brake job in November. Together, those 4 hits came to just over $1,209. Marcus didn't have 4 emergencies last year. He had 4 expenses he never planned for. And that distinction between a true emergency and an expense that was always coming is what keeps him from ever feeling ahead. Here's what I want to cover in this video. I want to show you the simple rule for separating the expenses that belong in your emergency fund from the ones that should never be there, and walk you through the real dollar cost of mixing the two up, because for most people, that cost is significant and completely invisible. Most personal finance advice starts here. Build an emergency fund, save 3 to 6 months of expenses. Keep it accessible. Don't touch it unless something goes wrong. That advice isn't wrong, but it's incomplete, and the gap in it is exactly why so many people who do have an emergency fund still feel financially fragile every time a bill they didn't expect lands. An emergency fund was designed for one thing specifically: randomness, a job loss, a sudden medical situation, a water heater that fails without warning. The entire point is that you cannot predict these events, so you keep a buffer ready to absorb the impact when they arrive. But most people don't only use their emergency fund for random events. They use it for anything that doesn't fit inside their regular monthly budget. Tires wear down, the dentist finds something, the car registration arrives, the annual insurance renews, and every time one of these hits, the emergency fund takes the blow because there's nowhere else for the money to come from. This is not a discipline problem, it's a system design problem. Most personal budgets have 2 buckets: money going out every month and money being saved. That structure handles routine expenses and genuine emergencies reasonably well, but there is an entire category of spending that doesn't belong in either bucket. And when there's no dedicated home for it, it slowly drains the one account that was supposed to stay protected. That category has a name. It's called a sinking fund. And the principle behind it is simple. A sinking fund covers expenses that are predictable but not monthly. Not random, just infrequent. You know they're coming, you just don't feel them in your normal budget rhythm because they don't arrive every 30 days. Most budgeting conversations draw a line between regular expenses and unexpected ones, but that's the wrong line. The more useful distinction is between predictable and unpredictable. Irregular does not mean unpredictable. Your car will need tires, your teeth will need a dentist, your roof will eventually need attention. These aren't surprises. They are certainties with variable timing. Treating them like surprises is the structural flaw that causes budget blowouts for people who are otherwise doing everything right. The way I think about it, your emergency fund protects you from what you genuinely cannot see coming. Your sinking fund protects you from what you can see coming, just not on a monthly schedule. Both are necessary. Running only one of them leaves the other exposed, which is exactly what keeps happening to Marcus. Let me walk you through what predictable irregular expenses actually look like when you total them across a year. Most households have 5 main categories. Cars. The average driver spends roughly $1,452 a year on maintenance and repairs: oil changes, tires, brakes, filters. A more significant repair, like a transmission, can run anywhere from $2,900 to over $7,000. Even setting major repairs aside, $1,452 a year means $121 a month your car expects from you. If that number isn't somewhere in your budget, it's coming from somewhere else: home maintenance. The standard guideline for homeowners is 1% of the home's value per year. On a home worth $284,000, close to the national median, that works out to about $2,840 a year, or roughly $237 a month. Older homes frequently run 2 to 3 times that. None of this qualifies as an emergency. All of it is predictable. Medical and dental, out-of-pocket costs vary, but for a household with standard insurance, you're realistically looking at $1,200 to $1,800 a year in co-pays, dental work, prescriptions, and the costs that coverage doesn't fully absorb. Irregular, yes. Unpredictable, no. Annual bills, car registration, insurance renewals, subscriptions billed once a year. These arrive and feel disruptive because they're infrequent. But the renewal date was always on the policy. You had the information. You just didn't pre-allocate the money. Personal replacement, laptops, phones, appliances, things that don't last forever and need replacing on a cycle most people ignore until they're making a reactive purchase they weren't financially prepared for. Add these up across a typical household, even a renting household with no mortgage. And the total usually falls somewhere between $3,000 and $5,000 a year. For homeowners with 2 cars, it often reaches $7,000 or more. That's anywhere from $250 to over $600 a month sitting in a category that has no name in the budget and no home in the plan. Take Sarah. She rents her apartment and has always assumed sinking funds are a homeowner concept, so she's never built one. But when she goes through her last 12 months of statements and writes down every non-monthly expense, the list looks like this. Renter's insurance, $187. Car registration, $147. Holiday gifts, roughly $340. Medical copays over the year, $230. Annual subscription renewals, $214. A car repair she'd been putting off, $420. Total, $1,538. And she hasn't started a laptop replacement fund, so when that comes due, it'll land cold. She's spending roughly $195 a month on expenses that have no category in her budget. Every time one hits, it goes on a card or comes out of savings she then has to rebuild. And look at James and Lisa. Combined take-home is about $8,600 a month. They own a $310,000 home. 1% maintenance puts them at $3,100 a year. 2 cars together cost about $2,904 in annual upkeep. Out-of-pocket medical and dental averages $1,380. That's $7,384 a year, $615 a month. That appears nowhere in their budget. They have a $6,000 emergency fund that gets hit constantly, and they've genuinely never been able to explain why it won't hold. The answer isn't bad luck, it's that there's no sinking fund. The fix is mechanical, not motivational. Here's how to build this in one sitting. Pull the last 12 months of your bank and card statements. Write down every expense that wasn't monthly. Every registration, renewal, repair, copay, annual bill, and irregular purchase. Add them up. Divide by 12. That number is your monthly sinking fund contribution. Then keep it separate from your emergency fund. You don't need a different account for every category. One dedicated sinking fund account with a running note of what each portion covers is enough. The structure matters less than the separation of intention. Emergency fund money sits there for the unpredictable. Sinking fund money is for the infrequent but certain. Once both are running, something concrete changes. The car repair in November stops feeling like a setback. The insurance renewal stops disrupting the month it falls in. Your emergency fund stops absorbing hits it was never designed for. And the low-level financial stress that comes from watching your savings drain and rebuild, that fades. Because the money that needs to be there is there. Most people think financial security means having a large emergency fund. But an emergency fund that gets drained 4 times a year by expenses that were never actual emergencies isn't security. It's a slower version of the same instability. The goal isn't a bigger buffer. It's a system where every category of expense has a home before the bill arrives. Your emergency fund should be boring, sitting there untouched for months at a time, because everything that was ever going to come for it was already covered somewhere else. If your budget keeps surprising you, it's probably not because you're bad at budgeting. It's because one bucket is missing. If you want to go deeper on the emergency side of this, specifically how to size that fund correctly for your actual situation, that video is already on the channel. And if this one landed, subscribing means you'll catch the next one when it drops.